Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we're going to be chatting with Dan Kent. He's the co-founder of the site Stocktrades.ca, which he started back in 2016, so before the pandemic, with the goal of providing great tools and resources for investors to manage their own investment portfolios. And I think he does just that, and our goals align really well there, which is nice to see. And so I'm really happy to have him on the channel today. He's got a ton of really great deep dives into different ETF strategies on his site, so I encourage you to check it out. I feel like he provides, again, a really deep dive and an unbiased review looking at the pros and the cons of all these different solutions. So definitely check out Stocktrades.ca. We're going to be talking today about asset allocation ETFs in a little bit more detail. These are super popular ETFs and great for DIY investors. But before we get started, a quick reminder that today we're not providing investment advice or recommendations. Today's episode is all about providing education, as I mentioned, to Canadian DIY investors. So Dan, welcome to the channel and thanks for joining me today.
Yeah, thanks for having me on. It's going to be fun.
I know you're in Calgary, so how's the Stampede invasion going out there? Almost over?
Yeah, I don't really go to Stampede all that often. It's kind of like I think it's like a lot of Calgarians either love it or hate it. I haven't been in quite a few years because of how expensive it is.
Yeah.
I know it's going to be pretty hot there today because I think it was 35 degrees yesterday here.
Oh my
So
God.
it's probably, I think they were measuring the grounds and it was 40 some degrees out on the grounds. So
oh yeah, that might be something to stay away from.
Yeah.
I'm in your camp there.
Yeah.
So let's talk about on your site, stocktrades.ca. I was reading you say the goal is to produce more self-directed investors. And I like that. I feel like you do give the confidence to go and do it yourself. But curious as to your thoughts in terms of what you're seeing as the biggest challenges facing the DIY investor today.
I would say there's a combination. Probably number one would be information overload. Just even like somebody who's been, even somebody who's been around this for 10 years or so, 10, 15 years, like there was no TikTok, there was no like Facebook shorts, even YouTube shorts. YouTube wasn't all that big. It was a little easier to navigate, but now like there's so many creators, so much information, a lot of good information, but also quite a bit of not optimal information. So I mean, navigating that environment, like all the different strategies, like growth investing, income investing, options, covered calls, all this different type of stuff. Like it's very hard. It's probably relatively easy for somebody who's been in the markets for a while to navigate around it, but I think with new investors it gets a little more difficult. And then even on the fund complexity end of things, you have like synthetic ETFs, you have covered call ETFs, ETFs with double, triple leverage. It just gets really confusing on that front as well.
Absolutely. The sheer amount of them, right? There's
I think
1,500 and 1,400 in Canada now.
Yeah, I think I can't remember. I think it was in 2003, there was something like 300 publicly traded funds. And now like in North America, it's like over 5,300. And a lot of them have come in the last decade or so.
Yeah, I think that's a good point. Just the total information overload, the number of products, and the ability to sort of weed through some of those more complicated strategies and weed through the marketing, I guess, and get to the crux of what that product is going to be providing. What would you say are your best practices for DIY investors in order to overcome some of these challenges?
I guess for somebody who's like brand new to the market, I guess finding somebody you trust, somebody with, a long reputation for providing, rock solid information. I mean, there's so many, like I said, there's so many content creators out there. It's very hard to, navigate the market and find out, what's optimal for you. I mean, it's so, like, investing is so tailor made to the specific individual that it's kind of difficult to ever, come up with a blanket information for everybody. So, I mean, trustworthy resources would be absolutely key. Verifiable information, information that people are backing with, historical data, things like that, and not just, you know, from a inherent bias, I guess I would say.
Yeah. I think I don't know if you've checked out our tools on our website, but we just launched 8 new tools on BMOETFs.com that are
Okay.
free for investors, and we've provided those tools through Investor with really scrubbed and clean data. And I think that's, you know, the best practice to help with your challenge of just the sheer number of ETFs available on there. We've got screener tools and comparison tools that not just looking at BMO ETFs, but looking at all the ETFs available and mutual funds in the Canadian marketplace. So I think that's a resource that people can go to do some of that homework too.
Yeah, I mean, that's a prime example of a trusted, resource, ton of history, like big reputation, ton of tools that help investors out from, a major Canadian institution.
Yeah, and as I said, I feel like you do a good job of seeing both sides of telling the full story on any type of solution, right? Like this is who it might be good for, this is who it might not be good for. So I do give you credit on that front too.
Yeah, like that's pretty much our main goal, is to lay out the information without any type of bias, any type of, preference for any specific strategy. Just lay it out how it is, explain how it is, the pros, the cons, and then from there somebody can choose what strategy they want to follow. But I find where it gets into trouble is you kind of lean towards, if you're leaning towards one end of things and you have somebody who, follows that specific strategy, it might not be optimal for you, but if you're following that type of information, there's a bit of bias there, which ends up, it's difficult to navigate all the information out there today.
You've written a number of articles on the topic of asset allocation ETFs on your site. So walk us through, sort of from a high level perspective, how these work.
Yeah, so traditionally, like for somebody who would want to own, like, say, a mix of equities and fixed income ETFs, you would have to go out and either buy the individual equities and fixed income investments like bonds or money market funds or whatever they may be. And then you would kind of have to balance that individualized. But these asset allocation ETFs are all in one ETFs. I find they're called quite often.
Mm-hmm.
They pretty much do that work for you. And then they have different, allocations. You could have 100% equity. You could have an 80-20. You could have a 60-40. And then instead of somebody needing to go out and buy, individual equities or equity ETFs, they could buy an all-in-one ETF, which would have, I believe most of them have 10,000 plus like underlying holdings in them, like made up of just stocks and fixed income investments. And I find the fixed income area of it is actually even more convenient, rather than, a while back where you would have to, go to the bond market and buy an individual bond, which is probably a pretty
Unheard
complex
of these days.
process. Yeah.
Yeah.
Whereas now, if you don't want to own individual stocks, you don't want to pick individual ETFs, and you say you want an 80-20 equity fixed income portfolio, it's just a single click now, instead of a long process of, either finding individual ETFs you like and fixed income ETFs or individual bonds.
Yeah, so that diversification is definitely a huge benefit. What are some of the other pros and cons of that all-in-one approach from your perspective?
I mean, I would say the one-click solution, diversification, it's instant for somebody who, wants a very set and forget approach, I would say. I mean, the other thing, it simplifies it. The rebalancing would be
Yeah.
automatic. Whereas, if you own, let's just say you own individual ETFs on the equity and fixed income side, and one, performs better than the other. In order to get back to that allocation, you're going to have to rebalance. You might not know when to rebalance. You might, not stick to a rebalancing plan, whereas these funds just automatically do it for you. I'm not sure exactly on the frequency of them, if they're annually or quarterly or semi-annually, but most all of them are always going to have rebalancing. And then on the fee end, like they're higher fee than, say, like a just a like a an index fund or something. But when you think of the fact of, if you don't have, say, let's say, commission free trading or something, you might spend a bunch of money rebalancing that on your own, those individual positions, to the point where the fees from a cost effectiveness are actually not all that bad.
Yeah, that you're right about the free trading is coming up a lot more on
Yeah.
ETFs, but not every brokerage has that, right?
No.
Yeah, I think that the fact that they can be used in so many ways too is what makes them such a unique tool. Like, from my perspective, they're the best invention since the ETF was created, because they fit so many different needs at such a low cost. But how could an investor use these in their portfolio?
So, I mean, you could use, because they have so many holdings. I mean, I know a lot of people who just use them as that's pretty much all they own. It's just a core position in their portfolio. It's a one-click, fully diversified, whether it be, like I said, the 100% equity, or whatever asset allocation you want. Secondly, you could use them as like a satellite type option, where it's a big chunk of your portfolio, and then if you want to buy individual stocks, individual ETFs with something else, say you like a particular industry, a particular stock sector, things like that, that you believe will be promising in the future, you could hold a large portion of an all-in-one ETF, and then kind of, tackle it from that approach. And then the third approach would be pretty much splitting the all-in-one, to the point where you might own the bulk of it, but say you want to reduce your exposure to a specific area, let's say Canada or the US, you could own the majority of that all-in-one and kind of find a different fund to replace the section that you might not like. I mean, a prime example would be if somebody didn't maybe they don't want to own US mid caps or small caps, so they instead allocate more to something else. That's something that I've seen a lot of people do. Or they want to lower their Canadian exposure, raise their Canadian exposure, things like that. Because overall, these funds are just 5 or 6 ETFs that are coupled into one ETF, right? So there's a
Yeah,
lot of ways you can do it, but those would be the 3 core ways.
I think the idea of sort of using them as an asset allocation guide is good, because I
Yeah.
mean, we attend a lot of conferences and stuff, and that's always the question, like, how do I build a portfolio? Do I just buy ZSP, like the S&P 500? I'm like, well, you probably want a more diversified
Yeah.
portfolio than that. But like, how much do I put in each segment? So yeah, I think that's a good way of looking at it too. Is like, maybe you have a view on the U.S. that it's going to be super volatile, and you want to put a low volatility exposure in there instead of just having the broad market. You can really tailor it a bit better that way.
Yeah, exactly. Because it's not like these have, what it like 10,000 plus underlying holdings, but really they're all basketed into, 5 or 6 ETFs. So it doesn't really take all that much to fine tune it to how you want. Or alternatively, you can just one click it and let it do its thing.
I've also heard the approach where, again, sort of taking out the building blocks and doing an asset location type uh, technique on it, where you put more tax effective strategies in your non-reg,
Yeah.
and that view as well. But it's clear, like, every single ETF provider has come out with these. I think Vanguard was first. We were a little late to the party, but have a nice robust lineup now with some of the lowest fees out there. But walk us through, like, if an investor is looking at it, like, why would you buy one asset allocation ETF over another? Like, what should they be considering?
I mean, I would guess risk tolerance would be one of the big things. I mean, a lot of people might not be comfortable with 100% equity allocation. Some might want that 80/20 in terms of, reduced volatility, because fixed income, I mean, it got a little bit crazy during COVID, and even now that rates are going crazy. So they've been a little bit more volatile than usual, but normally, fixed income does bring with it lower volatility usually. So an 80-20 portfolio, although it's never guaranteed, obviously, it should be less volatile than 100% equity, and a 60-40 even goes further. But then the other element would be obviously income. I mean, fixed income, it's called fixed income because it generally provides income and not a lot of capital appreciation. So somebody, with 100% equity all-in-one ETF, you're probably not going to get that high yield, just because, I mean, you can think about it, the Canadian market generally, we have a lot of blue chip Canadian stocks that are higher yielding. But with an all-in-one ETF, it's probably going to be that higher income on that end will probably be offset by the fact that the S&P 500, along with those mid cap and small cap US stocks, don't really yield that much, so it might bring that yield down. So you might need to get, if you're looking for yield, you might need to get that in the form of, reducing it to an 80-20 or a 60-40. So risk tolerance, income, I mean, overall outlook on the market, I guess, all those types of things.
What about when it comes to the ETF issuer? Like what BMO, Vanguard, iShares, Horizons, Fidelity, you name it. Every issuer has these products now. So what would someone look at when trying to figure out from an ETF provider standpoint?
I mean, I guess there is like a multitude. Pretty much every major fund manager now has these all-in-one ETFs, and they're coming out. A lot of fund managers compete with each other for the same ETF. So, I mean, I guess performance and fees would be one thing that you would want to look for. Fees relatively important, and performance net of fees. A lot of people look fees first and then performance after, when in reality, the performance net of the fees you pay is probably the most important element. But I mean, a lot of the funds are structured, they're all-in-one ETFs, but they are structured a little bit differently as well. Some will have more Canadian exposure. Some will have less Canadian exposure. Some will have more exposure to the mid and small cap US markets. Even on the fixed income end, some might have more corporate bond exposure, whereas the others have more government bond exposure. So it's pretty easy to dig into. Like, most websites lay it out quite well, like what the exposure is, different countries, different sectors, things like that. So
Yeah. Another plug for our comparison tool. It lays it out
yeah,
really nicely.
exactly.
But yeah, I think looking under the hood is super important, because I've even noticed asset allocation ETFs out there that have crypto exposure in them. And I think a lot of investors have started to sort of think, I can just buy anyone. They're all
Yeah,
exactly the same. And
no,
they're
they
not
definitely
quite.
aren't.
There's slight differences. I was looking today, and BMO has the lowest, if we're looking at the all equity category, the ZEQTs of the world. We have the lowest Canadian exposure by a small amount,
Yeah,
which I like. We've all got a home country bias already. We don't need to. So I thought that was a point that I liked for BMO at least.
yeah, that's like, that's the most important thing, is a lot of people think they're all the same, but they really aren't, because there is some, well, I think there's one that contains crypto. So you have cryptocurrency plus, all these other things, whereas, like you said, BMO is the lowest Canadian exposure. So if you don't want all that, much exposure to the Canadian market, that's something to look at. But
Helped in performance this year, that's for sure.
yeah, exactly.
Yeah. You mentioned cash flow, or a lot of investors call it income. We like to call it cash flow. But for investors who are looking for that monthly cash flow, maybe they're retirees, are there all-in-one solutions that would meet that needs for them specifically?
Yeah, I would say that for the most part, it would be, those lower allocations towards equities and more towards fixed income is obviously going to increase the yields. Like I said, you're probably not going to get, because it's, 9,000 plus stocks in some of those all equity ETFs, you're probably not going to get the yield you would want other outside of something like an 80-20 or a 60-40. But that all depends too, because it brings on a different element. Do you really want, 40% bond exposure to get that fixed income, or can you get it somewhere else? Different things like that. So there's a lot of elements at play there.
Yeah, I think one solution we've seen some interest in is ZMI, or monthly income asset allocation ETF. And that one is basically just wraps our dividend focused ETFs and our covered call ETFs to get that enhanced monthly cash flow. Another option would be like a zbal.ta or a zbal.t or a zgro.t. These are T series. These are really popular in the mutual fund side of the world, but I don't think a lot of ETF investors maybe understand how they work. But a T series is basically guaranteeing you 6% in cash flow every year. So these aren't for everybody. These are for people who are looking to fund whatever retirement or their bills through that monthly cash flow. I think it's important to understand that that 6% could be a portion of return of capital depending on what the markets are doing in any given year. But it's still nice to have that option that you can, draw a steady monthly cash flow from if you need it.
That's pretty interesting. I'll have to check out those T series funds. Are
Yeah,
they
those
newer?
were there. Yes, I think we launched them just over a year ago
Yeah.
now. And we went with 6%. So in the mutual fund world, there's 4% T series, 5% T series, 6%. We went 6%. But yeah, as I said, like if you're in ZBAL and the markets didn't do their thing that year and you didn't get your 6%, you will get a portion of return of capital, but you are guaranteed that 6% every year.
Yeah, those funds are pretty handy as well. If you're looking for like a locked in, month, well, not monthly, I guess that would be a 6% annualized distribution. Those would pay.
Annualized, yeah.
Yeah.
But it
Yeah.
means
So,
you
I
don't
mean,
have to
they're,
sell it every month, right? Like you don't have
yeah,
to be.
exactly. But I
Yeah.
mean, they're pretty handy. Like you said, if the market performs poorly, it will probably be, a specific, just for them to hit that 6% threshold, they will have to pay out return of capital. But if the market does well, they're pretty attractive for sure.
Awesome. Well, thanks for all your insights, Dan. Anything you want to shout out about Stocktrades.ca that I might have missed?
No, not really. I mean, you can visit us on Stock Trades. We have our YouTube channel. We're getting back into YouTube videos. I do the Thursday episode of the Canadian Investor Podcast, so
Yes,
people
that's
can
right.
find me on there as well. Once a week with Simone. It's a great podcast. We typically talk more on the stock end of things, but we've done some work on ETFs as well.
Yeah, I love that podcast. It's very good. All right. Well, thanks again for joining me, Dan, and chatting asset allocation ETFs with me. We've been a huge proponent of these forever because I think it's a great way for investors to stay invested in the market over the long run with like that diversified approach. And we all know it's all about time in the market, not timing the market. But again, check out Stocktrades.ca. And if you like today's episode, please remember to subscribe or feel free to comment below and let us know how we can improve the channel. Next week, we'll be back looking at the trends in the ETF market. Specifically, we're going to be looking at flows monthly and year to date and some insights that we can glean in terms of what the investing population is doing, both in Canada and south of the border in the US. So join us next week. That's all for today. We'll see you then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.